All right, now we are going to go through as an example of a trading process, an analysis process that I would take. Because trading, you can trade with any concepts. Me, what I'm teaching you here is what to follow, what to look out for. Terminologies can change, words can change, words can deviate. That's none of my business. And that's all okay. What's most important is, do you understand what you're doing? That little thing you understand can make you more money than the very many things you don't know. Because there's something in human beings always yearning to want to know more. Like the men of old, when you read Greek mythology, they tell you that the Grecians, the Gentiles then, were seekers of wisdom and knowledge. There's a point reached where in Athens they had over 1,000+ gods, because everything they would discover and it was new, they would worship it. They would look for they would always be on the edge of what's new, what's new, what's new, what's new, what's new. It's human nature. But that's not what sets you apart. What sets you apart is that 1, 2, 3 things that you ignore every day, but you can understand so well and harness so perfect. That's what sets you apart. Mastery. So you have to strive for mastery in everything that you do. Strive for mastery. So these things that I'm telling you, you can use any concepts, whether you want to use trend lines, whether you trade Wyckoff theory, whether you trade price action, whether you trade smart money concepts, whether you trade candlestick patterns, they matter. Any system that you trade, any trade analysis that you trade, we're going to just focus on the basics. Now, me personally, in the way I understand things and the way I see how the markets flow, I found smart money concepts to be a little bit logical. I borrowed some things from smart money, some things from price action to put together something that makes much sense to me. So if you're even to take my other extensive course of teaching, I go deeper, but in that concept. But don't worry, this is just a beginner guide showing you where you come from and how you gauge. So for the case of, let us assume that we all trade the concepts I trade. Okay. Let's assume you trade the concept I trade. I want to lay a few fundamentals and then go into the charts with you to see what would be my thought process. How do I think? How do I refine? How do I correct? How do I improve? Things like that. Of course, I'm not going to show everything because it will make the video so long, but I want to just show you a typical way. You can watch this video over and over again to internalize and grasp the concept. Number one, I trade. Let me first try to put here a box of words that I can say, okay, box is green. Let me make it white. Maybe make it white and make the text black. So, number one, I look for structure of the market. Number two, I look for points of interest, which is supply and demand for my case. If you trade any other concepts, you know what your points of interest. This is just a point of interest. Some people call them POI. So when you hear someone talking about POI, your POI, they just mean the point of interest. For a support and resistance trader, their points of interest are support and resistance. For an SMC trader, it's supply and demand. Yeah, the concepts of supply and demand come way handy because it's how the market moves. The market is always looking out for orders, where big orders are seated. And the people who move markets are people who have a lot of money, banks, institutions, and what have you. And for them to move their money to fill their orders, they need to locate areas which have a lot of money. So different things happen in the market just as a consequence of that. Not that big traders are always looking to swallow up small traders, no. Because they may even not know where your stop loss is, but orders are always clear where they are. And for them, they're always there to fetch out more orders. Okay. Then the last thing I could look at for now for this video is the market inefficiency. Simple concepts. What is the market structure? Let me get my thing here. Market structure is simply the so-called direction the market is taking. So-called direction. If it's in an uptrend, that's how the market structure will look like. If it's in a downtrend, that's how the market structure will look like. It will make this, and make this, make this, and make this. make this, and make this. How do I confirm that this is the market structure? For me, I look for these breaks. Every time it makes a break, I look for the previous high, and if it was broken, look for the next high. Was it broken? Oh, yes. Look for the other high. Was it broken? Oh, yes. So these breaks are what we call break of structure. So when you hear me talking about BOS, and there was a break of structure here, and there was a break of structure here, that's what I mean. I mean, the market is now serious, heading for a certain direction. This is the same thing that can happen on the downtrend. Okay? Same thing also for the downtrend. It keeps breaking structure. Keeps breaking structure. Look at the previous low, and then it comes and breaks and makes a new lower low. Breaks the previous low, comes breaking a new lower low. Now, what are the points of interest? The points of interest are the points where the market reacts to move in its direction. For example, this market is going up. The points it keeps reacting are these ones here. Okay, I made this thing white. Let me take it back to green. At this point, whenever it reaches this point, it reacts. It goes back up. So for me, when I'm trading, I always want to know which are these points of interest. Because most likely, if the market bounced when it reached here before, if it comes back again in future, it could bounce again. Because that means there are very many orders stated here, very many buy orders stated here. That's how the concept of supply and demand works. The concept of supply and demand is supply and demand are the pressures that move the market. When there is too much demand, the market is pushed up. People are buying. When there is too much supply, the market is pushed down. So these are concepts that are used interchangeably. These are the concepts that are responsible for how the market moves. Is there too much demand of the token, too much demand of a good? Price reacts. Is there too much supply of a good? Price reacts. When a good is scarce, you realize that it becomes expensive because it's scarce in our normal day-to-day life. So these are the concepts that drive how the market reacts. So sometimes, this is how the supply and demand concept looks like. Let me delete this. You'll allow me to delete this. Allow me delete these. Allow me delete these. Allow me delete these because I already drew them down here. I want to expand the screen just down here for you to see. Because I have to actually run an example. We have to get into the real life chart and see how actually the whole concept works. The structure is number one. Structure is this. Now, concept two is supply and demand. This is our supply and demand. So I want to represent it to you, not to forget it. Let me first delete this to clear my space. So supply and demand looks like this. The supply zone is that zone where the market comes, gets into that zone, and then reacts away. And then sort of when it comes back into that same zone, the moment it taps into that zone, it reacts away massively. So the supply zone will always look like this. Me, I like keeping my supply zones red. So you allow me to change the color again to red. So this is how the supply zone looks like. Now, there can be a mini uptrend here, but the bigger picture is the market, once it gets into the supply zone, it will come and break structure. It will look for this low, break it, and create a new lower low. Because this is the market structure. You can look at this image here. A lower high, lower low, lower high, lower low. Whenever the market is downtrend, it creates a series of lower highs and lower lows, lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. When it's in a series, you're not going to create higher highs, higher low, then higher high, then higher low, then higher high, then higher low, then higher high. Like it's going down. This one is lower high, then lower low, then lower high, then lower low, then lower high, then lower low. Like it's going low, 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 low. That's the structure. But this structure sometimes can look something as disorganized as this. It can look at something as disorganized as this. It's going up, then it kind of retraces down. This pullback you see here, for example, like from here to here, I want you to see, like from here to here, going down like this, can be disorganized like this, can be shabby like this. But bigger point is it's going down. Then once it reaches that point of interest, it bounces off and continues up. So the market will never be organized and clean like how it looks like here. No. But all you have to know is understand the concept. Once you've understood the concept, to be you improve your eye. The first thing you have to learn is learn how to read the structure. Your eye will get sharper and sharper and sharper and sharper. You're learning how to read the structure. Number two, you learn how to read points of interest. That's a supply and demand. Oh, there's a supply zone here. And before you know it, the market reacts to it. The same can happen for a demand zone. A demand zone can come like this. The market comes into it and then it reacts. And then in future, when the market is sort of coming back down, the market is coming back down. Once it reacts into the demand zone again, it goes up. So it will have, your demand zone will be here. We're going to learn all these things slowly by slowly. Just showing you. So this is how now the demand zone would be. Previously in this area, the market reacted. And when it comes back, it reacts. So the last concept I shall be looking at is how or what we mean by a market being efficient and inefficient. Point number one is you will first master how to read the structures of the market. Can you notice a higher high? Can you notice a break of structure? Can you notice a higher low? Can you notice a lower low? Can you see what point is lower low? What point is higher high? Can you see continuous breaks of structures before you say this is a trend is upward or downward? Number two, can you then see points of supply and points of demand? Number three, can you see market efficiencies and market inefficiencies? What do we mean by this? Whenever a market is efficient, it will move like this. Well, example, if it's going up, to move coming up like this, then come down like this, then continue up like this, then come down like this, then continue up like this, then come down like this, then continue up like this. So let me show you what that means. Now here, it will be leaving what they call demand zones around here. The demand zone here, but when the market came, no, there's a demand zone here. When the market came, tapped into it, it reacted again. Then it created another demand zone here, another demand zone here. And then the market comes, taps into it, then it reacts again. Then it created another demand zone here. Then the market comes, taps into that demand zone, continues. Now here, the market was moving in a very efficient manner. Don't worry, you're going to understand. Then here, there's another market which can move like this. It's going up like this, then comes down like this, then goes up like this, and comes down like this, then goes up like this. This market is said to be not moving in an efficient manner. And consequently, it will be causing, let me see if I can get an arrow. For me, I get an arrow here. Okay, good. It will be leaving these spaces you can see here. These spaces you can see here. So on my chart, when you see these arrows, they mean the market is inefficient. And in most cases, it will be leaving these gaps. What are gaps? Gaps are those spaces in the market where we either call them imbalance or market inefficiencies. So when you hear me talking about market inefficiencies or imbalances, that's what I mean. I just mean the market has moved and it has failed to fill the imbalance and then it has gone up. In most cases, it's the distance between candles. It happens whenever the market goes up with a very large force, boom, and just continues up. In literal sense, to keep the market balanced, it has to first come back down, fill all the orders it left, then continue going back up, because the market moves by orders. It doesn't move by magic, it doesn't move by sentiment, it doesn't move because these people hate these ones love these ones stealing these ones money. No, the market is triggered by orders. You get the point? Just like in a normal market, when I buy my tomatoes and I have them, they will get done if I get many orders. And once they are done, I'll order for more tomatoes and bring. I don't order for tomatoes because I love them so much, but business has to move. Get what I'm saying? My tomatoes don't remain with me because I love them so much. It's because I don't have buyers. So the market always moves by orders. So an efficient market is a market that whenever it moves up with a lot of momentum, it has to come back and fill the gaps it has left, collect all those orders and continue. In most cases, when it's coming back, we expect it to react from what we call a point of interest, which is a supply zone. That's why we study how to read supply zones or demand zones. For the case of bullish trend, there are always demand zones. For the case of a bearish trend, there are supply zones. A simple definition of a supply zone or demand zone is just that zone that has a market consolidation. The market consolidates, the market consolidates like this before it goes up. So in that case, we know that if the market comes back around the same area, it will receive more pressure to move up. So if the market is coming back down like this, if it taps into this area, we expect it to move higher. If it's in an upward trend, it will always have those consolidation areas before it moves. before it moves. Generically, it could be going up, but when you look at it keenly, so you will learn how to read those zones if you are a supply and demand trader. If you're not, you learn how to read whatever you read, whatever you read. The people who trade patterns, the people who trade chart patterns, they look for head and shoulders, they look for what and what. Point is, it's a point of interest. It's the resistance, point of interest, it's a support, point of interest. That's the bigger picture. But me here, I trade supply and demand because I know when I can read supply, when I can read demand, I can know, the market has many orders seated here. I have to wait for it here. I be patient and wait for it to come to me and we go together. Other than me rushing and up into it randomly and it crashes me, we crash with it. So there are two concepts we're going to look at. Allow me delete these, not to keep my, you can always pause the video, rewatch, re-listen, and get those concepts back. You will allow me just delete this briefly. Then we look at an example. I'm going to use a replay. I'm going to use a back testing. Let me first get something here. Ready? So these are the three concepts we're going to look at today, right now in this video. I'm using them to build my system that I used to create. These were things I was using earlier on, but yeah. So the supply zone happens up where the market, when it reaches, it goes down. Reaches there, it goes down. Reaches there, it goes down. That's the bigger picture. Demand zone is when it taps into it, it gets pressure, receives enough energy to go up, energy to go up, energy to go up. So yeah, let me come back shortly. All right, so we are going to continue from here. This is an example of Ethereum. When was this? This was around January 2024. So many of you are not even aware of charts. So here I want you to notice that I have come to conclusion that this market is bullish. Reason being, it keeps creating break-off structures. This was the previous high. It came down, then it came up. And these break-off structures, we normally consider them after there is a full candle body closure. I'm going deeper than I'm supposed to go. I'm not supposed to go this deep in this video because it will be so long. But bigger picture is there's a break of structure. The market comes and closes above. Comes again, closes above. Comes again, closes above. So I'm interested in saying, this market might be bullish. So because this market is bullish at this point, what am I going to look for? I'm going to look for an area of interest. What was the consolidation area before the market plummeted up? And when you look at it, there was a serious consolidation here. And then the market zoned and went up. Do you see the magic? This is how the market always moves, ladies and gentlemen. When you study, you will see it. Even before this break of structure, there was a consolidation here, in this zone. Even before this break of structure, there was a consolidation here. It can be small, but it was there. The market first, then after it plummeted up, then A, then A, then A, then A, then A, then A. This was a big consolidation right here, but this is not part of the video. Let me first remove this, so we can continue. Bigger picture now is there's a consolidation here. Now for us, we don't take the whole consolidation in most cases. We just refine it to the last candle before the market went up. So let me first remove this line so that you can see the candle very well. I was just keeping that line to help me keep the spot. Let me keep it here. So I'll get this last candle here, but then also consider to cover all the wicks here. So what is in my head is, or you can even consider to cover this last week here, just for the case of being safe. But when I drew that zone, I am saying that the market has left me, it's going up. But I am sure, at least if it comes back around this area, let me enter. When I enter, let me see how much profit it can give me. So we are going to play and see if the market comes in, and then we can ride the ride up. What's happening? I think my network is being slow. My network is being slow. It has eradicated away my command zone. Let me draw it again. I'm just drawing it on that last red candle. I'm covering this last week, but also can cover this one, just to be on the safe side. Let me see if I can play. I think my network is not working. I wanted us to play it out and follow through together. So I'll show you how normally the trade setups run. Let me first see if I can fix something here. See if I can fix something here shortly. Okay. Okay, good. Okay, good. Okay, let's go back there. Good, perfect. Let's go back there. Good. Hope you can see my screen and we can move. Let me see. Good. Okay, now we see the market is playing out. You see, the market is playing out. The market is playing out. The market is playing out. It's still consolidating up there. Wait and see, will the trade come for us or it will not be able to come for us? Okay, we see now the market has hit in. Now, generically speaking, I will get this long position thing. Okay, if you don't know where they get it from, you tap here. You tap here. I think it's blocking me now. I think it's now blocking me. Let me first get the pencil. You tap here, ladies and gentlemen. Hope you can see. When you tap there, there is what they call long position. So when you get long position, come and place it. Because remember, I was supposed to wait for the trade to come into my supply zone. So most cases, I'll be entering the trade when it is up here on this supply zone. Then this thing helps you measure and see what will be your stop loss. So if I put my stop loss here, I am saying that I'm willing to risk 7%. And then what is my target? My target is normally, I want to take back this thing up above where it came from, because I know the market is bullish. So it has to come back and break this structure, break this highest point and continue going up. So I'm saying, okay, I'm risking here. It shows you everything. This is the risk is 7%. That's where the stop loss is. The target is at 20%. Number two, my risk reward ratio is 2.6. I go back to my rules. Can I take this trade? You remember? You check, can I take this trade? Let us play and see. Did this trade stop us out or it can actually give us some profit? Let me see. Can it give us some profit? It's playing out. 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 You can see it's playing around our entry. Then it go up, then it comes down. Remember, it hit into our supply zone. It's going up. It's going up. Okay, perfect, 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 perfect. That's enough. That's enough. Now, when you look at this trade, it's a sweet 20% trade, 2.6 hour trade. Risk is 7%. You go back. So in crypto trading, you'll have to check things like what leverage are you using? How much money do you risk per trade? How much money do you risk in a trade of your entire account? Like, let me say, the basic rule, we always risk 1% to 2% of the entire account. So if you have only $100, any trade you enter, you can only risk 1 to 2%. That is like $2. Yes, it may look small, but if you stay diligent and just compound, the money can be turned from $100 to $1,000. The 1% becomes 10 to $10,000. The 1% becomes $100, $100,000. 1% becomes $1,000. So it's just a thing of consistency and let your system reward you. I was just showing an example of the things that I considered. Number one, I looked at the structure. Number two, I looked for my key level. Number three, I look for the supply zone. Let me show it to you here. The market inefficiency that was here. How do I see that market inefficiency? I look at the market pumping up so hard, and then I check, did the market go up in an efficient manner? I come and check. Okay. I see this candlestick went up, and then this candlestick came back down. It filled all the orders it had skipped. Then it went up. But on this candle, let me show you how we see. Let me first remove this line. We normally judge if a candle has a gap by the candle before it. Where did the candle before it end? This one ended here. I'm looking at this big green candle. The candle before it ended here, and the candle after it ended here. So by that time, there was an imbalance from here up to here. And this imbalance has been filled so well. So there's a person who can say, me, I'll enter the trade after this imbalance is filled around this zone. But me, I say, let me wait until this actually comes back into this demand zone. And that's what it was. The market came down, filled the imbalance, then tapped a little bit. Once it tapped into this demand zone, it found a lot of buying pressure, which pushed it back up. It was again failing to go up. It came back down, tapped a little bit, and then got enough momentum to go up to an extent that it was able to break structure. Okay? Yes. So for this video, these are the only concepts we're going to look at, but that's just the whole idea of the trading. So all your concepts are fractal. This same thing we have done on this time frame, we can do in a smaller time frame, and we're going to do. Okay, thank you very much. That's it for this video. Let's meet in the next video. But that's the whole idea. Build a trading system that you can replicate, you can run over, you can do. Yeah, those are just few concepts. I was just showing you the market structure concept in application, demand and supply concept in application, and market efficiency. Just that alone, as simple as those three concepts look like, can deliver to you a 20%, and you're good. This 20% if you're using 10x leverage is 200%, ladies and gentlemen. This is the 1 day time frame, so this trade didn't happen in just a blink of an eye. No? It took over, let me say 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. So it took around 2 weeks. 2 weeks of 200%. I mean, it's worth waiting. You get the point? But that's for a longer time frame trader. Yeah, but you can do exactly what I've done here on a smaller time frame in 1 minute, in 5 minutes, in 15 minutes, if you are a scalper or day trader. Yes, but you have to do it from first to do analysis. Here, I was just doing it on one time frame, one time, da-da-da. So the next video, I'll show you how do we now make such good trades become more and more perfect. How do we add soup to it to make it more and more perfect? Okay, let's meet in the next video.